Welcome to Capital Decanted. In this show, we say goodbye to tired market takes and superficial sound bites. Because here, instead of skimming the surface, we dive into the heart of capital allocation, striking the perfect balance and exposing the subtleties that reveal the topic's true essence. Prepare to have your perspectives challenged as we open up the issues that resonate with the hearts and minds of those shaping capital allocation. We've enlisted the wisdom of visionary leaders in the industry, and just like a meticulously crafted wine, we'll allow their insights to breathe, unfurling their hidden depths and transforming our understanding. This is Season 1, Episode 13 of Capital Decanted, Blockchain Computing. I'm John Bowman.
And I'm Christy Townsend.
And we are your hosts. First, a huge thank you to our Season 1 title sponsor, Franklin Templeton Alternatives. With over 40 years of alt investing and $260 billion of assets under management, they've assembled and offer specialist investment managers across 6 different asset classes: private debt, hedge funds, real estate, infrastructure, private equity, and venture capital. And of course, all of them operate with the client-first mentality that has always defined Franklin Templeton to prioritize investment outcomes. Now, listeners, if you've been listening for several episodes, you'll know that we've been cycling through many of those alternative managers across those 6 different asset classes. And rightfully so, we have Roger Baston, who is Executive Vice President and Head of Franklin Templeton Digital Assets, with us today at halftime. So make sure you stick with us for that interesting conversation. So thanks again, Franklin Templeton Alternatives. Christy, I'm pumped about this one. Really excited. The research, I think, just unlocked and unveiled a lot for me, a lot of aha moments. And I'm really looking forward to learning along with you and the listeners. So I want to start with a quote that all of you will recognize. And that is, "This time it's different." And that was famously uttered by Sir John Templeton, but it's often represented as the most dangerous 4 words in investing. But I want to suggest to you, with all due respect to those of you that position it that way, that an even more dangerous version is a 5-word adaptation that says something along the lines of, "This time is never different." Because frankly, sometimes it is. There are moments in history where everything changes. Social, economic, financial, and technological foundations quake, and the aftershocks are monumental. And to think otherwise, that we live in some incremental, modestly upward sloping autopilot civilization, well, that's the thinking of someone who hasn't studied history or invested very long for that matter, and certainly one that is never going to capture innovative breakthroughs or revolutions. The role of the investor, as we all know, is to try to identify when things are in fact going to be different, particularly when the majority of investors disagree. Now, I should be clear, the large majority of the time, and the reason people, I think, often exclaim it this way is that most of the time, it is in fact not different. And we don't want to be Chicken Little or chasing waterfalls, pick your metaphor, every time new tech products are launched. But what we're trying to suggest is that too much dogma and clinging too much to nostalgia can sometimes cause career misses that are really hard to come back from. So with that in mind today, we want to challenge both the crypto skeptics as well as the crypto bros and gals to join a more important debate, a more significant thought exercise. So we are an equally opportunity offending show here. Everybody's going to be a bit challenged here. We're not taking sides. We're trying to raise the gaze of everyone involved. Capital Decanted exists, as we often say, to preach balance and objectivity. And we want to, you might say, rewire and disaggregate our thinking and then rebuild it back with a broader conversation. And here's what we mean by that. So often, the magic beans and the rat poison crowd, if you've heard of that, are reacting to one specific application of blockchain computing. And that, of course, is digital currencies, crypto. And by the way, I think the large majority of us will condemn garbage meme coins and absurd NFTs. But even if you want to hate on Bitcoin, and some of you do, I still think you're missing the point and taking a reductionist view of the subject that we're going to try to tackle today. In fact, I tend to be with Jenny Johnson, who is the CEO of Franklin Templeton, when she states that Bitcoin is the biggest distraction from the true story, the transformational power of blockchains themselves. Frankly, I'll speak for myself here. The whole digital gold, libertarian, unbanked crypto opportunity to me is a sideshow that gets in the way of the real question. It's not that there's not hope there. I just think it's a small subset of the real story. which is blockchain technology the next computing paradigm? To me, conflating the use cases or not of cryptocurrencies today with the efficacy of blockchain networks overall would be like back in 1999, disavowing the future potential of the internet because you didn't like e-toys. So that particular use case may or may not pan out. And of course, e-toys did not. But its particular failure said nothing on the usefulness of an infrastructure that now, of course, allows for electronic commerce, communication, connectivity. It's changed our lives completely. So don't get caught up in one particular application and make a decision on the future based upon that. So today, we're neither arguing that blockchain computing is, in fact, that next paradigm or not. We're certainly not authorities on the subject. I think Christy is going to say much the same today. But we do want to better equip us to assess, particularly unemotionally, the conditions and environments that typically exist in these type of technological cycles. And I hope that will help us develop a conviction, one way or another, on the subject. We want to get away from the intellectually lazy and stubborn arguments over this coin or that coin. As I said, this is much less about trading these digital financial securities and much more about a new computing movement is what we really want to debate. So here's what we're going to do today's episode. I'm going to walk through some of the theories around technological supercycles and their traditional elements and phases. And I'm going to use the help of some brilliant economists and thought leaders that have spent a lot of time thinking about this. And along the way, what I'm going to try to do is weave in examples and anecdotes from previous tech revolutions that some of you might be familiar with to help us better understand and bring to life how this typically plays out. I'm also going to include some of the conventional wisdom around why blockchain computing may be, huge emphasis on might or may, show signs and hints of being that next one. Then Christy is going to warn us about hype and FOMO, which is a critical element of being a good investor. She'll spend some time identifying thematic catalysts that might alter or should alter your investment thesis. And of course, the unique nature that we need to keep in mind on VC or early stage investing. And finally, we're going to invite into studio a massive source for this episode, one of my very favorite tech experts, and probably, I think, generally considered today's foremost authority on blockchains, Chris Dixon, partner and founder of the crypto practice at A16Z, or most of you might know as Andreessen Horowitz. Chris, by the way, released a book on tech revolutions called Read, Write, Own, Building the Next Era of the Internet, which I read in preparation and I would highly commend. Really challenging and exciting read. So we're going to do something a little bit different. A little programming note, first of all, is that as we begun preparing for this, it was clear that we wanted to deep dive into these technological supercycles and then identify and wrestle with whether some of what blockchain computing offers might be a sign that that could be the next one. And in order to do that, as we thought about who we could pair with Chris, it became apparent that we just wanted to dive much deeper with Chris Dixon. So unlike our traditional pattern of interviewing two guests, we are just interviewing Chris today. So I will be doing that myself, and then we'll be bringing Christy back in for the last step. So speaking of my co-host and partner in crime, Christy, before we get started, Bitcoin, blockchain, and bubbles, oh my. What is your starting point on this whole space as an investor? And frankly, its future promise as an investor before we dive a bit deeper here?
This one's always been really hard for me because, to your point earlier, just so much of the passionate discourse and even memes around this discussions in this space focus more on the digital currency side versus on the blockchain side. So I think that always gets a little bit wrapped up. And there are some people who are very passionate as well. So it is very hard to have any thoughtful discussion of pushback with some people. But I do appreciate that on the institutional side, investors are much more likely to have these conversations, particularly as the price of Bitcoin increases hilariously, in my opinion. So on Bitcoin itself, obviously, people who want to go out there and learn how the market works, it helps to have a small position in it to play around with it. Honestly, it helps for institutions in some instances to hedge their digital security risk, if you will, and ransomware risk. So I've heard of organizations doing it for that reason. But I have yet to hear about a full-scale institutional jump in on this side, and with good reason, because I think with Bitcoin and even with blockchain to an extent, if you have processes that are centralized for the most part, whether that be a centralized data clearinghouse or a centralized currency through the United States of America, those things are really hard to dislodge from our society, particularly when you get the government involved in stuff. So I'm always a little hesitant to, as somebody who loves technology, to just be like, this is going to change the world, because while the libertarian side of me loves the idea of decentralization, the pragmatic side of me is it really better than a more centralized system? And in some instances, I could say yes, but in a lot, the idea of it is exciting. But when you have, for example, a blockchain that takes up the same amount of energy as a small country, you run afoul of your ESG practices or your energy practices. And then there really is this throttling to the growth prospects just through these kind of random points in the chain that you wouldn't necessarily expect. So it's exciting on one hand. Some random person just threw a paper out there and created a currency and now people trade in it. That's wild. And the technology itself is interesting as well, just in the proofing and ability to be decentralized. But the execution of it, I still think, is going to be really hard in a world with 7 billion people and a $156 trillion global economy. So long-winded way of saying, I love the idea of the technology, but I'm really hesitant to say that it's going to be truly transformative in a very quick period of time.
Well, you said a lot of important things there. First of all, we need to be careful. I said it a moment ago too, but the shiny new object chasing, as we'll talk about at length, most of these things become pretenders. Most shiny new objects are not the next computing paradigm by definition. So we got to be very careful. You also said, is decentralized better than centralized? I don't think we know yet. I think there's some advantages and disadvantages. And speaking of disadvantages, you highlighted one that at least historically, despite recent transitions, have been huge drains on energy. Speed is also one that you give up in a blockchain computing network. So we'll talk much more about advantages and disadvantages. All of these paradigms come with them, initial trade-offs. And I think you're right to be pointing that out. That is what we're here to assess today, is exactly that. So let's jump in. As I said, I want to zoom out a bit before we zoom back in, a little bit of a round trip up and back, and talk a little bit about technological cycles, because I think it's important context for a debate on, is this the next one? So first of all, super cycles generally have a long history in the halls of academia and economic and social theory. I would guess most of you learned something in undergrad or graduate school. Perhaps the most famous supercycle theories you might recognize way back in the recesses of your brain are the technically inspired Elliott wave or the technologically grounded Kondratiev wave. And again, we're going to talk a little bit more about Kondratiev in a moment. He was a Soviet economist who, by the way, Christy, I saw was executed for his evangelism of the topic. So that's not a good omen for this episode. So we should watch our backs here. But despite the general dismissal of these thinkers and long wave theory generally, no one can deny, with the benefit of history, that when the gods, if you will, periodically align geopolitical tailwinds and technological breakthroughs, extended periods of economic vitality, wealth creation, and capital market returns can occur. As I said earlier, things are different sometimes. It's rare, but they do change. So think about Han Dynasty paper, the British Navy, the steam engine, electrification, and more recently, a subject we'll talk a lot about today, the internet, are a few examples of these types of changes. These transitions shouldn't be likened to market timing opportunities that demand asset allocation tweaks around the edges, but these are tectonic shifts of the global economic crust that alter history and reset what we consider to be normalcy. So Joseph Schumpeter, an Austrian economist, further developed Kondratiev's theory to apply them to business cycles. And I bring him up because we will all be familiar with the phrase that he coined, creative destruction, one that we talk about all the time. It's become synonymous with progressive breakthroughs that replace and make obsolete old innovations. So we'll be referring back to Schumpeter again momentarily because he has inspired a few of our go-to economists that we'll mention today. In the last half century, as the global economy has deepened its reliance, think post-World War, on its addiction to silicon, as the technological cycle has really sped up, and technological platforms have become the most powerful of these disruptive cycles. They've reshaped not just economic booms and busts, but the very rhythm in which businesses and consumers conduct their lives. So think of the personal computer in the late 70s and 80s, the World Wide Web in the 90s, the smartphone in the 2000s. These are largely agreed to be the last three revolutionary platform changes. So before we turn to attempting to identify that next cycle, Is it blockchain computing? Is that the next cycle? We first need to ask what history can teach us about the typical shapes and behavior and conditions of these past cycles so we can help identify one when we see it coming. And as I've hinted a few times, I want to consult with a few modern oracles and authorities that are worth paying attention to on this subject that might give us a mental map of how these paradigm shifts usually play out. So the first one, and probably the only of the few I'll mention that I would guess the majority of you won't recognize. It was the one I didn't recognize. And I'm going to spend most of my time here because I think not only has she influenced some of the others, but because we aren't familiar with her, I think it's worth spending a little bit deeper evaluation of her work. So Carlota Perez is a British Venezuelan scholar who researches the concept of what she calls techno-economic paradigm shifts. Big mouthful. Which is, in her words, the theory of great surges. And as you might expect, she was heavily influenced by both Schumpeter's business cycles and Kondratjev's long-run economic waves. Perez has spent her career studying all the major technological innovations since the Industrial Revolution and their interaction and influence on capital markets. Her seminal work, if you're interested, was published in 2003. So just, again, thinking through your mark of history, that's right after the dot-com bust. And it was called Technological Revolutions and Financial Capital. And I've listed that in the show notes. And by the way, she apparently, despite her now being over 80 years old, I think, is working on a sequel called The Social Shaping of Technological Revolutions, which also sounds very interesting. So anyway, the centerpiece of her original work that I want to dive deep on is a curve. It's a really helpful visual that she calls the Perez Technological Surge Cycle. And it has 4 phases, this cycle: eruption, frenzy, synergy, and maturity. So according to Perez, the first 2 phases, eruption and frenzy, are defined by fervor. As hype outpaces sensibility, gobs of venture capital money pour in, and retail narratives take on grandiose conclusions. We've all seen that movie before. And you can hear the rhyme of Schumpeter's work here. Creative destruction catalyzes these savage and nasty battles between old and new paradigms. And think of the scorn and the ridicule and the hater mentality we're experiencing now in crypto and blockchain that Christy just alluded to. So that is not abnormal. And we're also going to weave in some of these dot-com bubble histories and lessons as we progress, by the way, through this Perez cycle. And I think perhaps the most iconic moment in the frenzy phase, as she calls it, of Web 1.0 was the January 2000 Super Bowl, where dot-com companies dominated the multi-million-dollar advertising for the big game. Now, if you're not old enough to remember this, or if you haven't seen these, or if it's just been a while, frankly, for entertainment, you need to Google some of these spots from what is now dubbed the dot-com bowl, as they range from the absolutely hilarious to the completely ridiculous. So just a few that might just tickle your memory here. There was the Electronic Data Systems, or EDS, cowboy cat herders. There was the When I Grow Up, I Want to Be Monster.com ad, the famous dancing chimpanzee at E-Trade, and most notoriously, the sock puppet campaign from the company that perhaps most infamously embodies the whole era, Pets.com. This stuff is so good, it belongs in a museum. So history, by the way, you might be thinking does repeat itself. Sometimes it's more than rhymes. It actually repeats itself, especially with the so-called Super Bowl test, which is becoming, I think, a sign of the top in many ways. Think about the 2022 Super Bowl, which, just like the dot-com bowl, has now been dubbed the Crypto Bowl for the exact same reason. Go back and Google these. The terribly cheesy Future Favors the Brave Crypto.com ad with Matt Damon that just has not aged very well at all. There was the bouncing QR code by Coinbase, which, by the way, Christy, I thought was very clever as an 80s guy. I thought that one was really good. But then, of course, with the benefit of hindsight, the most cringeworthy of them all, Larry David's The Next Big Thing for none other than FTX. And we know the story there. So just like for the dot-com bubble, crypto fervor wasn't just an episodic spending spree at the Super Bowl. There was all kinds of things going on in that same period a couple years ago. Think about the likes of Steph Curry and Justin Bieber joining the Bored Ape Yacht Club, whose NFTs reached $1 to $2 million each. And not to be outdone by Bored Apes, a few crypto punks surpassed 10 million of value on sales of these NFTs. And sticking with the NFT theme, most famously, the Beeple digital painting sold for an astonishing $69 million. And all the while, these are the NFT examples, but we had several multi-billion-dollar market caps for meme coins that have no real purpose, things like Dogecoin. And this is what I think fans the flame of some of the nonsense and the anger that is understandable. But I think the point here, the reason I'm raising all this is that none of this is surprising to the cycle. This is the pattern Perez claims is expected. All this frenzy leads to the inevitable. And we've quoted this before, but F. Scott Fitzgerald, the famous author, wrote in his memoirs, quote, "The restlessness reached hysteria. That leads, as Perez says, to the popping of the bubble." The preceding collapse is certainly violent and painful. If you've been around more than a minute, it results in losses for all stakeholders, but it's also a necessary turning point for the latter two stages of Perez's curve to be enabled. Most importantly, at this point, pretenders and nefarious actors began to be exposed during the crash. Valuations reset aggressively, and the fundraising spigots really shut down and get much more discerning. So the big and somewhat counterintuitive contribution here from Perez that I really want to underscore is that smack dab in the middle of her surge cycle is effectively that, quote, as she says, "Nothing important happens without a crash," end quote. So this painful turning point post-crash is what boomerangs, you might say, the staying power of a new platform shift. Without a crash, you're probably looking at a pretender that lacks a true disruptive punch. So let's go back to the .com with this crash lesson in mind. Let's take a look at the .com crash with Perez's lens. On January 14th, 2000, the Dow Jones, which peaked just under 12,000 and a level it would not return to for more than 6 years. Tech-heavy NASDAQ, even worse, peaked on March 10th, a couple months later at a little over 5,000. And I'm going to say this slowly because I think it shocks a lot of people. A level it would not reach again until March 2015. That's 15 years later before it recovered to the March 2000 levels. Just let that sink in. From that March 2000 peak all the way down to the trough it reached on October 9th, the NASDAQ would lose nearly 80%, 80% of its value. Put that into a little bit more perspective. One source I looked at claimed that 1.7 trillion US dollars of losses were incurred during these 7 months by investors in ill-fated .coms that had negative cash flows. And by the way, while we're confessing, at least while I start confessing, one of the more notorious ones, Webvan, still chastens and humbles me, Christy, to this day. I had all of our PMs in this IPO as a young, zealous analyst. And for a few months, I must say, I felt very smart. The market cap skyrocketed to $8 billion after going public, only to go defunct a little over a year later. So I still got nightmares about that one. But all of us have those stories. As I said, it does make you a better investor because it still haunts you and orbits in the back of your mind when you look at these hype cycles. So compare that to today. Those .com, I think, very visceral drops and crashes and wealth destruction. Compare that to today. Bitcoin and the larger crypto indices have famously had several violent cycles, peaking in 2014, 2018, 2022, and then each then suffering 80% or more corrections. These currencies' wild swings, I want to be clear, again, where we started this episode, certainly don't reflect the enterprise values of much of the underlying infrastructure, but given they are symbolic and also so much of the founder's wealth is tied up, foolishly or not, on the token side, it has begun to cleanse the system of the fraud and the hucksters and a lot of the get-rich-quick schemes that always are part of the early stages, as Perez says, of these cycles. So think of OneCoin and Genesis Global and Celsius and Three Arrows, Terraform, Binance, and of course, we've already mentioned it, the granddaddy of them all, FTX, just a few examples. This is high-octane creative destruction, to say the least. And I would venture to say there's probably more to come. It's not completely cleansed out. But as Perez argues, these speculative manias don't just characterize tech revolutions, they often enable them. So think about it. All the money that poured into tech companies in the first half decade of the internet era built out the infrastructure and economic foundation that would allow the internet to mature in a tangible, physical way. So in the late 90s, more specifically, telecom companies raised over $2 trillion in capital to lay over 80 million miles of fiber optic cable. Just astounding. Now, after the dot-com bubble burst, there was severe overcapacity in bandwidth for internet usage. I remember they were basically shuttering, writing off, mothballing all of this stuff. It would never be used. Now, the silver lining, however, is that the fact that the tracks had already been laid enabled the next wave of companies over that next decade in the 2000s to deliver new internet services and business models very cost effectively. By 2004, the cost of bandwidth had fallen more than 90%, despite internet usage doubling every few years. So that was because there was plenty of cheap capacity that encouraged developers and builders and accelerated mass adoption. So in the greatest of ironies, oddly, Amazon and Google probably don't exist without WorldCom and Global Crossing, or at least it would have taken them much, much longer to realize the broad adoption that we know Amazon and Google have. And decades earlier, this same lesson applies to other networks that were built, and they thrived off the backs of speculative fervor. The railroads, the electric grid, the highway system, they were all overbuilt. They were all overfunded, only to later produce massive improvements in human civilization's quality of living. Chris Dixon, today's guest, is instructive here from his book, Read, Write, and Own. He says, quote, blockchains need big investments too. They require tooling and infrastructure, and the networks and applications that are built on top of them require capital to fuel growth. Big tech corporate networks spent tens of billions of dollars to scale to billions of users. Blockchain networks that intend to compete with them will require similar sums. And the crescendo of the quote, a little exuberance, whether rational or irrational, goes a long way, end quote. And I think Dixon is hitting on Perez's whole point. She argues that the crash is indispensable. It must happen if disruption and wholesale innovation has any chance to endure. It enables, it's a prerequisite, you might say, for her third and fourth phases, which she calls synergy and ultimately maturity. And these phases are characterized by creative construction. Notice the play on Schumpeter's words there. This is where sustainable use cases crystallize and revenue and profit models emerge. The scorn that we talked about already a few times also begins to mutate a bit into large-scale acceptance as the excess is largely washed out and more productive narratives around the new paradigm become commonplace. So, Christy just mentioned institutional adoption is early. Absolutely true. But are there signs that blockchain and crypto have crossed that Rubicon and started to become a little bit more acceptable? Maybe you might look at the SEC's approval of the Bitcoin spot ETF. A couple weeks ago, at the time of this recording, the state of Wisconsin, one of the most reputable and admired public pensions in the United States, invested $100 million in crypto. New regulatory regimes in Singapore, Hong Kong, Japan, and the UK, the EU, have all been stood up. So who knows? But certainly these are promising signs, at least for those that are considering this next paradigm is in fact blockchain. So that's Perez's work. And by the way, I'm really excited about her new book to continue that discussion. So that's the big one. I spent the most time there. Second, just quickly, the Gartner hype cycle, developed by the research and advisory firm. Many, of course, you know, Gartner. They've created a very similar graphical representation of the maturity, adoption, and social application of emerging technologies. They use 5 phases in contrast to Perez's 4. And I'm not going to spend a lot of time here because it largely echoes her work. But I do like the clever naming conventions of Gartner that I think will reinforce our discussion so far. So Gartner's 5 phases are the following. First is technology trigger. So this is a technological breakthrough, captures the interest of the media and the public with stories and proofs of concept, but very little commercial viability. Okay, this is the eruption in Perez's language. Then there's the peak of inflated expectation. Early publicity produces a few success stories, but often accompanied by scores of failures. So this is getting to the bubble of expectations. Then, of course, that bubble bursts, and Gartner's 3rd phase is the trough of disillusionment. I love that. Cynicism and anger rise as experiments and implementation fail to deliver. Producers of technology shake out or fail. So this is the burst. This is the prick of the bubble. 4th, following the bubble popping, the slope of enlightenment. Instances of how the technology can actually benefit the enterprise start to emerge and become more widely understood. And then 5th, and finally, the plateau of productivity. Mainstream adoption starts to take off. And the criteria for assessing provider viability, much more defined and measurable around real things like revenue and profit. So that all seems to make sense at the core. And that's Gartner. Very helpful, certainly drafting off of much of Perez's work. So, Christy, I want to pause here and just get to you before I move to our last influential sage that I'm going to touch on in this opening introduction. As you think about those curves, and you can use either Perez or Gartner's language or your own language, where do you think you would put blockchain computing on these graphs? If you had to plot its climb up to the summit, where would it be, do you think, using their rubric?
I think this one's hard because blockchain itself, divorced from the broader cryptocurrency story, doesn't necessarily benefit the masses in the way that, say, other technological cycles have, say, for example, the internet or whatever else. I don't think that people have seen quite the application side of what it can do for them as a everyday human, if you will. So it's hard from that perspective. I do think that because it is tied to cryptocurrency in so many instances, I think we've definitely hit the trough of disillusionment with possibly some green shoots coming out of this to the slope of enlightenment as corporations and industries are starting to think of B2B ways to incorporate blockchains into their workflow or into their processes amongst each other, whether that be, for example, moving to a quicker settlement or potentially using it for settlement of securities or whatever else. There have been quite a few broader industry specific potential uses for the technology itself. But within that, again, I think it's one of those technologies that's just really hard because there isn't necessarily that story for the masses. So yeah, I would say definitely we've hit the trough of disillusionment, especially when you add the crypto part to it, and then possibly with some slopes of enlightenment. But I will also say on the cryptocurrency side, it's very difficult because now you have governments who are like, oh, we're going to make our own cryptocurrency, which I think is so the antithesis of what crypto was always meant to be. So again, I think it's hard to divorce those two stories from each other. But I do still think that there is probably application within businesses and specific industry sections. What about you?
I'd agree with that. Again, rightly or wrongly, I think financial coins, digital cryptocurrency is ahead in this cycle for all the reasons you suggested. I don't think a lot of people understand yet the application of blockchain computing, the use cases. I think a lot of that, as I said, is because people can't get past the poster child of Bitcoin and they stop there and they make a determination, they have a view, and then they stop looking. I think we're going to try to unveil much more of the much larger story beyond cryptocurrencies today, which is the whole point of this episode. But I think you're right. I do think these three vicious and ugly cycles in cryptocurrency have perhaps turned a corner, and we just have to see where it ends up. I'm really hopeful that the broader computing story catches up because, as I said, I think that's the real headline here. So we shall see. But the last of the visionary sources on cycles I want to touch on. So we've talked a little bit about how cycles work, the stages that these paradigms go through. I want to go to one more source, which perhaps will help us determine how to spot the next cycle and maybe more precisely where they will come from. So Clayton Christensen, I'm sure you've all heard of this gentleman, was labeled the most influential management thinker of our time by The Economist. I didn't know this, Christy, but actually he grew up right here in Salt Lake City. I didn't realize that. But he became a distinguished professor, and most of us know him as an author out of Harvard Business School. And of course, his most famous work was The Innovator's Dilemma, brilliant classic book, which introduced the idea of disruptive innovation, which, by the way, that phrase is now ubiquitous in Silicon Valley and boardrooms and graduate programs around the world. But the book argues that the organizational strategy of firms operating in established, mature markets is not, and might I even say never, an effective environment or petri dish for new and disruptive technologies. And why is that? Well, Christensen argued that it isn't because executives of monopolies or category killers make bad decisions or they've got their head in the sand, but it's actually because they make good decisions, the same decisions that they made in order to make their companies successful. So why is that? What do I mean by that? Well, let's think about this. First, disruptive products, whenever they come, are often simpler and cheaper, and therefore they generally promise the supporting creative organization lower margins and profits, at least for some period of time. Second, disruptive technologies, similarly, are first commercialized in emerging or insignificant markets around the edges. It's the first movers, and therefore they're really not worth the investment or attention. That total addressable market is tiny at first. And third, customers of their own products, their own customers of their incumbent products, either don't want or they don't know they want a substitute. So they're usually quite content. So in sum, these leaders find themselves simply acting rationally and continuing down the path they've been on. A disruptive technology is initially embraced by the least profitable customers in a market. So why would those executives chase it? It's just psychologically rational. So in this vein, I'll just confess a little bit, maybe perhaps on behalf of all of us. It's easy in this vein to caricature Blockbuster or Barnes and Noble or pick your disrupted, disintermediated old bricks and mortar model that the dot-com bubble blew up. But honestly, those leaders were simply acting rationally. There was bluntly no responsible way for Blockbuster to compete with Netflix, for Barnes and Noble to compete with Amazon. They had to ride it out. Their business models could not transition. It couldn't have worked. And I think this is a little bit counterintuitive to how most of us think about the past and those that have been competed out. But this is what Christensen is really identifying. The innovator's dilemma is that in every company, there is a disincentive to go after new markets. And paradoxically, the rationale and the sound leader of the successful company will doom themselves in the long run because when they act rationally, ultimately they will not find that new market. So again, our guest today, Dixon, puts it this way. I love this quote. The reason incumbents whiff is that the next big thing often starts out looking like a toy. The first telephone in the 1870s, he goes on, could only carry voice short distances. So Western Union famously passed on acquiring the phone because it simply couldn't see how the device could possibly be useful to its primary customers of businesses and railroads. Now, of course, they missed how rapidly telephones and the underlying infrastructure would improve. But there it is. A century later, the same thing happened with the computer evolution that we're spending a lot of time on today. IBM, for example, laughed off many computer manufacturers like Digital Equipment and Data General because IBM quite enjoyed their supercomputer dominance. Why would they cannibalize their own business? In turn, DEC and Data General ignored PCs in the 1970s, allowing Dell and Compaq and Microsoft to control the PC ecosystem. And on cue, what did those three, that same trio, completely miss in the next cycle? The smartphone revolution. So it's not that they don't learn. They usually just can't pivot that foundationally. The business model is too rooted in their existing product set. Technology always gets better at a faster rate than users' needs increase. And the innovator's dilemma, it atrophies the creativity and the courage of the incumbent. So therefore, we shouldn't be surprised that most still view crypto and tokens as novelty and as, you might say, sophomoric. That's the pattern at these early stages. They look like toys. And frankly, I think as we've already hinted, a lot of this still is novelty and sophomoric. We're working through that system as Perez's cycle suggests. There's a British physicist that has a great quote here. His name is Freeman Dyson, and he says this, quote, when the great innovation appears, it will almost certainly be in a muddled, incomplete, and confusing form. To the discoverer himself, it will only be half understood. To everybody else, it will be a mystery. For any speculation which does not at first glance look crazy, there is no hope. End quote. Sounds similar to Dixon's point on the next big thing, always starting out looking like a toy. But here's the thing, again, we're here to both challenge you to think a bit bigger, but we're also here to caution you that we have to be careful with this. Just like in most of the time, it isn't different, as we started the whole episode with. In this case, some toys do stay toys. In fact, most toys in this context never get very far in their attempt to scale Perez's surge or Gartner's hype cycle. So how do you distinguish the duds from the truly disruptive? Dixon goes on to argue, and I'm excited to ask him about this in our conversation to elaborate a bit more. He says that technological platform breakthroughs are just not inherently disruptive. That's just the table stakes. The product has to be disruptive, has to be counterpositioned. However, what really distinguishes them is that they must benefit as well from riding exponential forces that cause them to improve at surprising rates. Again, going back to the telephone and the roads and the internet, it shocked everybody how quickly this caught on. Exponential growth, Dixon states, comes from stronger forces that create compounding effects and platform app feedback loops. For really the new paradigm to come, you must have this perfect storm of counterposition product or service. Again, that's the disruptive part, coupled with a generational coalescence of technical and social innovation. All of this needs to come together. So timing here, and frankly, Christy, you might even say a bit of luck, is also a very big deal. History's littered with brilliant inventors and founders and even great products that were disruptive in their inherent nature, but they were simply before their time. Think of Fairchild Semiconductor. They invented the integrated circuit. They had certainly a ride of success, but it wasn't until Intel caught the PC wave a couple decades later that things really took off. General Magic, I don't know if many of you are familiar with this, but they created a touchscreen technology as early as the mid-90s. By the way, there's a fascinating documentary on General Magic. They licensed this touchscreen technology to several other companies that launched failed products. The world, unfortunately, would have to wait another decade before processing power and app developers could support a true touchscreen device that, of course, we know as the iPhone. Artificial intelligence, of course, the hottest thing since sliced bread, has actually been around since the 40s. Predictive processing, neural networks, these are not new things. But of course, they remain largely nascent into the last few years until NVIDIA allowed us for sufficient commercial computing power to harness it in corporate and now consumer applications. And may I say, and maybe this is just my therapist talking, that Webvan or Lycos or even Pets.com wasn't wrong, because you could look at Instacart and DoorDash and Chewy today. They were just 20 years, just slightly early. As Mark Andreessen famously said, there are no bad innovations, only early ones. So that rubs my ego more than anything that I had it right. I was just 2 decades too early with Webvan. Oh, well, I'm not sure that's right, but there you go. So let me try to bring this all together as I close and hand off to Christy. The thread that runs through all of these cycles, particularly at their inflection points, is first, when the excess and overinvestment and hype pop, it destroys wealth. It causes a lot of pain. We shouldn't mindlessly ignore that. We shouldn't treat it as just academic. There's real lives that are changed and lots of wealth destruction. And perhaps finding more socially virtuous approaches to discovering new computing paradigms is a worthwhile debate and conversation, but certainly beyond the scope of today's episode. However, that dark winter we've been describing is often followed by a glorious dawn that unleashes a generation of opportunity, a transformation that far outweighs the momentary affliction of the crash. In fact, as we learn from Perez and Dixon's history, it's a necessary and beneficial process that cleans out the system, resets the cycle on a path of economic and enterprise formation. So if you play that logic out, and this is really important and maybe uncomfortable, depending on where you find yourself on this subject, maybe the most important thing I'm going to say that was an epiphany to me, this logic, as you take it to its extended place, it exposes a lot of irony, and I might even say cognitive dissonance in the common debate and fear-mongering, because if the dot-com crash, with all of its spectacle and theater, eventually portended the most important technological advancement of the century, perhaps in the history of humankind, what are we really saying when we ask if crypto is the next dot-com bubble? And I'll pause for effect there. Oddly, blockchain bulls, hear me out, blockchain bulls, they should be saying, I certainly hope it's the next dot-com bubble. Hopefully, I will do this with a little bit more humility and wisdom and intellectual honesty and not be a cowboy and full of hubris about it. And at the same time, the condescending bears, listen, you know, the get off my lawn, magic bean types, condescending bears, they should be hoping this is not anything like the dot-com bubble. Because if it is, they risk missing yet another super cycle of innovation. So it's a bit of a reverse of roles. We have this debate, is this another dot-com bubble? But I'd ask yourself, what are you really asking based upon history? So you need to come to your own conclusion. This is me talking. I don't know if this is the beginning of the next computing platform shift. These platforms have largely been on a 10 to 15 year cycle since the post-World War timeframe. So mobile is about that age now, or due, if you think that this is the typical pattern. You could argue that the next one is bound to come soon. You could certainly come to the conclusion that we've exhausted this rapid computer age for now. And even if we haven't, you could argue that blockchain is not the one. But you do need to be honest and do some deep research with an open mind, at least to write it off completely. Now, we're going to spend some time with Chris discussing some of the inherent advantages blockchain networks offer. And this was what Christy was getting at. I don't think these are widely understood. They haven't caught on. They haven't even created the, I would say, divisive debate that crypto has yet. And I do think they objectively extend and solve for some of the weaknesses of the current proliferation of network architectures, even if I'm not convinced it's the next paradigm yet. But just consider a few of the advantages of a blockchain network versus the network architecture most of us work on today. They're more secure and at the same time more transparent. Part of the reason they're more secure is that the code itself, the software itself, makes and keeps the promises inherently, rather than relying on a single leader or a corporate board. Facebook, Twitter, to not change the rules of the network or the community. It's tied up in the software. Nobody can change the Bitcoin code, no matter how much they don't like it. There's no leader. There's no board. Third, perhaps most exciting, the value extraction between creators, founders, and investors is much more equitable versus the take rates now that offer very little to content creators. So you create content on any of the social networks today, you get nothing, with the exception of YouTube. Take rates very low. The corporation takes all of that. And blockchain allows for much more equitable sharing and incentive of creators. Fourth, the token infrastructure allows for incentive alignment. Not cryptocurrency, but the token technology allows for especially early stage builders and content developers and investors to be incentivized, to have alignment. And then fifth and finally, blockchains have what is called composability. That's a name you hear a lot in these circles. And what that means is that theoretically they can be interoperable versus the traditional walled gardens that we see in most corporate networks today. You're either on one network or another, and you can't take assets from one to another, one doesn't talk to another, etc. So we'll discuss what that means for use cases of how these advantages might manifest themselves with Chris, but I do think this is worth a lot more discovery than most of us have given it credit for. So from an investment standpoint, you got to be really careful here. I'm just going to end by echoing what Christy said. Just as in the dot-com boom, much of the stuff being created now is probably going to fail. That's just how this stuff works. The large majority will go away. Most of this stuff is e-toys in new clothes. And I've heard Chris Dixon, that is, talk about the 2008 test when you think about early stage technology investing. I think this is a really cool exercise. Just imagine this with me. If you had tried in 2008 to prognosticate the future killer app the day the iPhone dropped, think about what you would have probably said. I know it's hard to do given what we know now, but you probably would have predicted more convenient mobile extensions of what we already did on our PC, which would have been, by the way, revolutionary in itself. Don't get me wrong. Email on your phone, text on your phone, Facebook on your phone. But no one, if we're completely honest with ourselves, would have imagined that you would have parlayed the GPS capability into hailing taxis with Uber or Lyft, or transform the embedded camera into a social sharing enterprise with TikTok or Snapchat. So in the same sense, we should expect, therefore, that most of the groundbreaking uses of blockchain are also not even in our imagination yet. All the more reason we need proper incentives for builders and developers to create great stuff that ultimately will surprise us and change us and improve our lives. So while I hesitate to give advice, a wise approach given where we are in this cycle is probably to segment the market out into the various categories of applications and models and just choose a couple opportunities in each, knowing that you're probably going to be wrong on most of them. That's how early stage investing works. You could decide the taxonomy for yourself, but some of those categories might be smart contract platforms, DeFi applications, social networks, intellectual property or creative outcomes, gaming. And yes, one of them, of course, could be currencies and NFTs. But just remember, that's just one. It is not the only one. And frankly, it's perhaps a less interesting play than the larger opportunity here, which is what we are encouraging you to think. So I'm going to stop there. Christy, I'm excited to hear about some lessons you might have with all of that cycle, mumbo jumbo, and history in mind. How should we think about this as investors?
Well, I was going to jokingly just start with let's go to the moon. Moonshot, YOLO, let's do it, fam. I'm obviously joking. And interestingly, this one's a hard subject in particular because I'll start by saying I don't have a ton of context in terms of what other institutions are doing, because while I know a lot of endowments in particular, I wouldn't say a lot, but a fair amount of institutions out there are moving into the space and investing in the crypto itself or in some of the technology around it itself. A lot of organizations still mostly are exposed through their venture portfolios. And so while people are still trying to feel out and understand the marketplace itself and how to underwrite it and how to think about it, there is obviously the confusion of, is it an asset? Is it a currency? I think everyone has pretty much decided that it is, in fact, not a currency. It can be used as one, but it is more so a quote unquote store of value on the crypto side, at least. And then in terms of blockchain, since so much of it is B2B, it's hard to necessarily do a direct investment of any kind. And thus, I do get the sense that most people, again, are still invested in this wave through their venture portfolio. which I think is a good thing. I think that that's a great way to get exposure. I think it's a great way to mitigate having to figure out exactly where we are in the hype cycle, because I think that a lot of times you can hear through experts who are investing in it at this time, people like Chris, who are actually in the day to day to have a better understanding of where we are possibly in that. But with all of that said, I love technology. My dad is an entrepreneur. I love reading about it. My husband, I think I've mentioned before, is director of AI applied machine learning for a healthcare firm. So this is something that I absolutely love to talk about. I love to think about, but I also tend to be skeptical of hype, as you guys probably have already assumed. And to me, the antidote to bad investments or to FOMO or to running into technology or some sort of technological quote unquote innovation is not by looking at people's fund flows, unless it informs whether or not you think we are in a bubble, but to not look at what other people are doing necessarily, but to really dig into new tech and understand the offering in that broader context, much like I believe Chris is saying in many instances. And to me, I think one of the most important things you can ask yourself just at the onset is, who's making money off of this? Who are the players? Who are the people? And how do they make money? Because I think the economist in me, or the undergrad economist in me, excuse me, is always going to wonder what the incentives are and how people are going to respond to those. So I think on the crypto side of it, that's always been difficult for me, because it does feel as though the whole point of it is adoption. And beyond that, there's no real profitability. There's no real product. There's no real use case, except for that the people who created the coin or the people who got in early on the coin can then go in and use the coin. And that is how they're going to end up becoming wealthy. And that kind of mimics other parts of our marketplace. So it's not necessarily a bad thing. It's just on that side, you really have to understand that the people who are pushing for it really do need adoption to be able to use it, to be able to unload it. Beyond that, in the blockchain sense, again, you have the broader use case right now is for government coins, which is a whole new level of dystopia in my mind. But more excitingly, for internal B2B industry specific use cases. And so then I look at that and I think, okay, well, it's really hard to make money off of that, because I think the bulk of that is going to go to the organizations that get together and create these. That's not to say that there isn't any money in it at all. It's just as of right now, I am not creative enough to think of all of the ways that we could make money. And I can think of a lot of the instances of, okay, yeah, we can make legal contracts, but how the heck are you going to sue somebody if something goes wrong? It doesn't work within our current construct. Right now, if somebody takes money out of your bank account, you have legal recourse to go to Wells Fargo or your bank. You have legal recourse to find that money in some instances. If you wire it out of the country, you're out of luck sometimes. But if somebody actually steals that money, does something, there's somebody you can hold liable on the other end. In crypto, that sometimes doesn't happen. And that's honestly one of the biggest reasons. I know some organizations that are trading in this stuff, but I would never mention them publicly, because it does open them up to security risk. Absolutely. It does open them up to becoming targets of things, because whether we like it or not, there is a level still built into the system of people being concerned about the security from that standpoint. So no organization is ever going to discuss about how they took out a $50 million Bitcoin ETF position just by virtue of being worried that somebody on the other side of the world is going to take advantage of them somehow. So going back to how I think about things in context, I then wonder, how does it actually work? For example, the legal recourse. For example, how do people actually access it? Is it a benefit to them, or is it going to help my 95-year-old Grammy as she sits in her house? Or is it built more towards younger people? And if so, could there be a more mass adoption? Does it make sense in the context of all of our offerings? Again, I think on the crypto side, it's really hard to displace the US dollar, especially with a constrained currency, for example, that has a constrained cap on how much it can make. I mean, as we know, when you constrain your currency, you create all sorts of panics and monetary policy issues on that end. So again, I struggle with there's going to be this mass adoption on the Bitcoin side. And then I also have no idea how I would possibly explain a blockchain to my Grammy and how that would benefit her. And you don't necessarily have to. It's just these are the things that I think about. So then as I go down the list, how does the supply chain work? What are the inputs? Who's making it? What are the legal requirements? What are the technological requirements? Can people understand those in a way that makes sense? Are they transparent on some level? What are its limits and what is it displacing? I think AI is a really interesting one for me on this point, because people think that AI is going to be this panacea of it's going to take everyone's job and we're all doomed. But then if you look at it, as of right now, it's really good at strategy games like Go and chess. But if you ask it, what's the best stock to pick tomorrow? I mean, that takes so many thousands of inputs that it's not necessarily an easily solvable strategy issue just by throwing data at it. And you also need the data, for example. That's another huge issue to the mass adoption on that side. So does it make sense? Are current practices too ingrained? Are we too ingrained in the way that we centralize a lot of our current processes? Are we too ingrained in the way that we use our current money? Does it really make people's lives better? I think I keep coming back down to that one. That's going to be a huge one that I'll go over in a moment. But what are the regulatory headwinds? What are some of the weird consequences, good or bad, that might come from the adoption of this technology? And then I think I put all of that together and build what I would call a mosaic of knowledge to help inform those decisions. And within that, I think one of the most powerful resources that I have built personally is just a highly diverse, weird in some instances, but awesome group of friends and peers across industries, people who have been operators, people who are technical experts, people who have other outside investments, and the ability to go to them and seek out dissent and heretics and seek out people who are leaning into the technology, people who are working on it, and really figure out what are its limits, what are its selling points. Because I think that honestly, having those secondary and tertiary views on things are really what help you build a better picture in your mind versus just being, oh, I can't explain it to my Grammy, so obviously no one's going to care about it. If I had stopped at step 2, then I don't think I can explain social media to her at this point. So I think that that's a bad way of looking at it. But once you built a good understanding and you talk to people and you really understand where we're going, it's the importance of also understanding catalysts for change. So what could possibly displace this in the future? What kind of headlines would you look for to see that this is being mass adopted and to pay attention to those? And to me, I think the most important thing you could do here is you have to read original source material. You have to find original resources. You have to find actual people who are in there and don't just read the headlines. Don't just read that so-and-so is putting $100 million. Don't just read that there's a new Bitcoin ETF because the headline doesn't matter. It's the adoption. It's the how people react to it. It's the, is this really a catalyst for adoption, or is it a catalyst for just more financialization? Or is it just a cool point that was going to be a flash in the pan? Really think about who does the headline impact, and then go read the story, read the research, read the academia posts, read the people who are in there, read Chris's book, go out there and talk to people. I think will give you the best understanding versus just, oh, so-and-so is putting $50 million into this new technology. So then I think the last point that I'll make is, given that so much of this is in the VC space, as John said, as Chris said, I believe in his book, and as many others have said, we're going to lose money in VC. You're going to expect to lose money. I mean, you're going to expect to hit a huge home run, but you expect to have a lot of losses, and that's okay. So I think it's very lazy when investors just look at the losses or look at the washout, if you will, and say, oh, this is a bad investment, or this is a bad thing to go into, or obviously it's failed. Because I think that while we have seen FTX, while we have seen a lot of bad investment in the space, I do think that any tech cycle is going to have that, and it's supposed to. So I just really hesitate to say that just because we're in this weird point where maybe I don't necessarily see the application and maybe it's not going to broadly help the masses, that doesn't mean that there isn't some pain point that this could solve for others and that could actually be adopted by the masses. And one last thing that I will, and then I'll end with this, and this is just me and getting older and shaking my fist at clouds, I guess. But with a lot of the technological advances that we're looking at right now, I am very curious about how they do help the masses, how they do help people more broadly. Because if you look at railroads, I can see how that totally helped people. The advent of the telephone, the advent of the internet, even the advent of social media, bringing people together. I definitely understand the benefits of that. But once you get into, okay, does crypto really help people? I can't answer that yet. Same with blockchain. And even with AI right now, we are seeing some like very dystopian narratives coming out of that. So when I look at is it profitable? Will it really change things? You do have to wonder if you're actually changing things for the better, or if you're just changing things for the sake of changing them and moving profits more to corporations and making it that much more difficult for people to live. So, because I think to the extent that you do that, you will run into more populism and more issues with people being really worried about how they feed their families and how they're going to make it in the world. So just being thoughtful of the end game for the technology itself. Does the exit make sense? Does it make sense within the tech stack that we have built as a society? Does it hurt people? And I'm not saying that necessarily you have to make investment decisions based off of that, but just be really honest and open with yourself when you're going into those, that there could be some regulatory or other issues and headwinds that truly come in to ultimately make it a difficult investment. So with that, I will turn it back over to you, John.
Those are such good points, Christy. I would remind us everything first looks like a toy, Dixon's point. So use cases and value are pretty elusive at this stage. So none of us should feel embarrassed or cynical about not being clear yet what the benefit is. I also would say the whole purpose of this episode is not to fall into the trap of zooming in on Bitcoin and what's the benefit there, and therefore missing the much broader story of blockchain computing, which to me is the much more interesting opportunity. Will Bitcoin ever be accepted at Starbucks? In some sense, who cares? To me, that's a minor part of this story. Avoiding the financialization story, to use your word, I think is such a good point, because the whole point of blockchain computing, if you look at the early stage stuff, is to avoid the corporate ownership of all this stuff. That's the problem with today's networks, is that Facebook and Twitter and all these networks, they own it all. And blockchain networks, as you said earlier, they decentralize it. They put ownership and control and value extraction in the hands of those that are actually contributing, not corporations. So I think there's some advantages that could come from that. And the last thing I'll say is I love your granny test. But I'd also say when Granny goes to watch a movie, she doesn't know nor care how that intellectual property was developed, whether it was a single person with the very value extracting studio or whether it was more of a blockchain shared created intellectual property universe. If she's on Facebook, she could not tell you, well, at least my granny couldn't if they were alive, how the network works underneath of the user application. And she frankly probably doesn't care. So if a social network ran on a blockchain and really incentivize content providers and still had the same interaction and product spec usability, I'm not sure Granny would care. So I think you're absolutely right. All this stuff needs to play out and the value. And I think the warning about virtuous use, is it just a good investment, but it's actually good for the world. The last few have been. Smartphones you didn't mention, but I'd also say that has been too. So we'll see. So we have exhausted that topic, I think, from Chrissy and I's standpoint. I think that's a perfect opening to invite Chris in to help us better understand these use cases. He's going to have a lot better idea in helping us imagine where this might go. But first, as I promised, I want to invite Roger Baston in, who is head of digital assets for Franklin Templeton. So stick around for halftime, and we'll be right back with Chris Dixon. Welcome back to Capital Decanted, and I am joined, as promised now, by Roger Baston. Roger is Executive Vice President and Head of FT Digital Assets, Franklin Templeton Digital Assets, that is. Roger, welcome to Capital Decanted.
Well, thanks for having me.
And listeners, as I've mentioned, we are taking a bit of a tour through all of the FT alternatives managers, and just delighted to speak a little bit about digital assets on this episode. Roger, why don't, for those of us that aren't as familiar with what you guys do in the space and the asset class, tell us a little bit about the business and the types of strategies that you guys employ.
Thanks for that. Look, there's several things that we're doing at Franklin Templeton as it relates to digital assets, and I'll break those apart real simply. I think we came to this space specifically because we were looking at how we might be able to utilize public blockchain infrastructure in operating just asset management. Distributed ledger technology is another word choices used for blockchain technology, and we knew that asset management was filled full of lots of ledgers, so there might be something to be doing here that we can be attentive to. So as we found a use case for using blockchain inside of the transfer agency transaction record keeping system wrapped around a mutual fund itself, we began to have a lot of understandings about potential future use cases outside of asset management for these public blockchains. So really the journeys have been threefold. One is building some infrastructure within the organization that we could deliver some tried and true products and strategies. We have an on-chain money fund known as Benji specifically that we have been working very collaboratively with the SEC for a period of time, and we've been building infrastructure around offering that product to customers and clients. And then this idea that these public blockchains and the tokens that they represent, some tokenomics for the blockchain value that may be accruing due to projects like ours that are built on these blockchain rails, means that there's probably just this giant new potentially asset that can be blended into clients' portfolios over time. So we've been building advice. It's a rapidly, dynamically moving environment. What is a digital asset? It needs to be filtered in order to focus in on what are the real capital growing opportunities where there's value. And so we've been building a pretty deep and robust investment team, understanding and filtering and offering advice around portfolios of digital assets and cryptocurrencies that can be woven into and alongside of portfolios for clients who see this future network investing opportunity come alongside of their asset allocations. And really the last thing that we've been doing is all of these blockchains are representative of networks, and we are operating nodes on those networks. We want to be part of the networks. Definition, if you operate a node on these networks, you're wrapped into understanding it more. We think that's an important lens for us to offer advice. The fact that we're not only just building in blockchain technologies and have an understanding of that, but we also operate nodes in the networks. All that comes together for this idea that there's advice inside of this burgeoning space that we intend to offer for our global clients.
Well, a really interesting set of activities that I'm sure listeners will find very interesting to pursue more. Roger, maybe just speaking of the SEC, obviously listeners would be most familiar with the recent news on ETF approval, but how should the average client think about including digital assets from a portfolio context? Is this for everybody? Are there certain client profiles you would suggest would be a better fit for incorporating this asset class into their long-term retirement asset pool or institutional capital pool?
I think there's a really thematic thing going on here. There are business models that are being created as a result of all of this telecommunication piping and computer hardware and software. And these are investments specifically in networks. They're not investment platforms, they're investments in protocols. And again, we've seen really interesting and we think lots of use cases for these public blockchains. And these are innovations that are going to continue to come forward. So there's going to be a number of different investment opportunities. But for sure, there's a thematic story going on here. And that's important because I think some of these themes play into other things that are happening, thematic investment things that are happening. Everybody knows magic words of the last year, ChatGPT and AI introductions. Blockchain technologies will synchronize with AI. Now, all of this is like a lot of immature markets, pretty volatile space. So there are things to be attended to and to begin to layer in investments, but these are long-term opportunities and you need to be patient inside of that. These aren't necessarily income-producing opportunities, but what we have seen is when you weave at least the historical risk-adjusted returns of these assets alongside of others, it helps create better outcomes. But it's not going to be substituting. I think what it's really complementary most is actually in those high-tech investment part of an investor's portfolio. These blockchain networks are complementary and maybe subject to some of those other tech-related investments that are also similar type. So that's how we're talking to people, and we're talking to those who are interested in investing now for long-term benefit.
Roger, I think you said it well. I'll underscore this idea of patience and long-termism for the benefit of ultimately investor outcomes. So well put. Roger, real pleasure to talk to you, albeit briefly. And thanks for the great work you're doing at FT Digital Assets. And listeners, I'd encourage you to check it out. And we will be right back with the rest of our program. Stay tuned. Well, welcome back to Capital Decanted. And as promised, I am just delighted now to be joined in studio by Chris Dixon, founder and managing partner of A16Z Crypto and author of his new book, which we'll talk about at length, Read, Write, and Own. Chris, thanks so much for joining us.
Thanks for having me, John.
You bet. So the listeners have heard quite a bit on the history of networking computing, some of the bursts and the bubbles and the cycles that you also outline really well in your book, and I know very much has defined the trajectory of your career. I thought we could get to some of the specifics of this era, this blockchain network era, in a few moments, Chris, but I thought we would maybe retrospect a bit first to kind of put this in context, because I know you, like me, still have some scars and some visceral memories of those early 2000s. And I think it's helpful for the listeners to think about both maybe the similarities and the differences as lessons for how we contextualize and put into and frame what we're going through now. So I maybe want to start with a chart that you have in your book, which is a somewhat famous exhibit from Gartner that they call the hype cycle. And it walks through these technological cycles of innovation trigger and peak of expectations, trough of disillusionment. I love that one. Scope of enlightenment, and eventually plateau of productivity. So, Chris, when you think about these transformational platform shifts, as you're assessing new ones that are coming down the pike and calling your name constantly, what conditions do you look for to determine whether this is truly the next big wave?
So it's a great question. So the Gartner hype cycle, or very closely related, is the historian Carlotta Perez has an analogous framework where you have this period of, I think she calls it eruption, and then disillusionment. And both of these track both the technology and the financial cycles. And obviously, none of this is physics. It doesn't always happen this way, but there's some deep truth to it. I think the key thing, if you just step back and you ask yourself, look at the world today versus the world 40 years ago, what's different? You go watch a movie, I use the example in the book, the TV show Friends, which I believe ran from like 97 to 2003, so whatever, 20-something years ago. If you watch that show, the world isn't that different in terms of the washing machines and the cars and the buildings, but there's one giant difference, which is smartphones and the internet. They have the internet. Actually, I went back and looked. There's one episode in the history of Friends in 7 years where the internet occurs. And it's one of the characters does online dating and they all make fun of him because he's a nerd because it was such a unusual behavior back then. And of course, half the plots wouldn't even make sense today because you just text somebody and clear it up instantly, some confusion. So there's this giant change. Working backwards, why did phones change and not washing machines or cars, or maybe cars are changing now with Tesla? And the fundamental answer is you have these exponentially growing forces that underlie computing. And specifically, people talk about Moore's Law. Moore's Law is this idea that it generally means this idea that semiconductors get faster, double every 2 years or so in performance. I argue and talk about in the book, I think, of course, that's important. The fact that the physical constraints on semiconductors allow you to do that matters. But there's really a better way to think about it is an economic phenomenon, which is with computers, you have somebody invents a computer like a PC, a mainframe computer, an AI system today, I would call a computer, smartphones, the internet in some ways is a computer. And then what happens is someone builds the infrastructure and then someone else builds applications on top of it. And what happens is as the applications become more popular, that then funnels money into the system. People pay for things. And that in turn makes the infrastructure better. And the improving infrastructure in turn makes the apps better. So to give an example, think about your iPhone today versus your iPhone in 2007 when the iPhone came out. The phone itself has gotten much better, the camera, the chip, but also the apps, Uber and Twitter and everything else. And what happened is iPhone first came out, people played around with some apps. I was involved in this period. And then people came up with some really good apps like Instagram and Snapchat and Uber. And those then made the phone more popular. That gave Apple more money. They invested more money. And so you ended up with this exponential feedback loop. Social products, networks like the internet, the web, email, those are social products. Social products too have exponential forces. The more people that use them, the more useful they get. Email is useful because everybody else is on email. And if you're the first person on email, someone said to me the other day, Alexander Bell was the greatest salesman in history because how the hell do you sell the first cell phone? Who are you going to call? So anything with a network effect has these forces. So to your question, I think you have to look at the underlying forces and understand if you're sitting there in 2003 and the internet crash has happened and you're in this trough of disillusionment, one way to look at it is, okay, this thing was overhyped and it's over. The other is, wait a second, there are these forces that are still continuing to grow. For example, broadband penetration in 2003 was growing. I have a section in the book about it. It actually was quite controversial. And in fact, I cited in the book, Pew Research had a study where they asked Americans if they wanted broadband, and the majority said no. And why'd they say no? They said no because basically at the time you used the internet for email and maybe to check travel websites or something. What those skeptics didn't see was you'd have this feedback loop. As you got broadband, entrepreneurs built YouTube and video sites and all sorts of other applications for broadband. And then once you had the applications, that then funded more broadband. And so to me, that's what I think about in my business. If you're in technology, if you're an entrepreneur, if you're an investor, you need to look around for these exponential forces. And this is really a lot of the themes of my book. So I think one exponential force is Moore's Law, and I call it the platform app feedback loop, where applications reinforce infrastructure. Another important forces are these network social forces, network effects. As networks get bigger, they get more useful. Another very important force, which I think is less understood, is what I call software composability, which I think accounts for the fact that 99% of the software in the world is open source software, which really surprises a lot of people, that the vast majority of operating systems in the world is Linux, which is a community of random people, and they beat out all of these giant companies. Why is that? Again, I think it's this exponential force called software composability, which I could talk about, but I have a whole section in the book on it. So that's what I think about. I'm always on the lookout for where are these forces and where are they being underestimated? And as an investor and entrepreneur, how can I do something that's on the right side of those forces, not on the wrong side? By the way, AI and all this stuff here, the first neural network paper was in 1943. It was an 80-year history. Why is it now broken out now? A lot of it basically comes down to the fact that you can now run these models at many, many orders of magnitude greater size due to the growth of improvement in GPUs, which in turn, by the way, why do we have great GPUs? Video games. So it's this very interesting, somewhat circuitous history there that led to these really impressive systems today.
So there's an element of these forces need to converge. You can have pieces of some forces that share the appropriate conditions in the environments. And I'm just going back to that visceral moment again, which hurts because I pick these scabs once in a while, Chris. And I think about when I pitched as a 24-year-old web van. And I'd like to think in my better moments of therapy, I was just 20 years too early. Maybe that's up for discussion over a beer one day. But the point with that is that online shopping, certainly online grocery shopping and delivery, was not a bad idea.
Instacart's a $10 billion public company.
Exactly. So I come back, it's easy to look at microcomputers, PCs, Web 1.0, mobile, you just described in detail, and maybe now blockchain, you would argue. But there's a whole lot that swung and missed in between. So how do you think about whether you're too early or whether this is a masquerader as the next era and distinguishing that from a real live shift?
It's a great question. So timing, I think there's two questions. There's what will happen in computing and when will it happen? And I think the first question, in some sense, is easier than the second question. And then what will happen? I mean, look, in my career, my partner, Mark Andreessen, likes to say, he's slightly tongue-in-cheek, but there's no bad ideas. There's only early ideas, to your webvan point. And I can't tell you how many times I've seen people write off categories of software and then they end up working later on. I mean, AI is a great example. I had an AI startup in 2008. And you didn't say the word AI. It was embarrassing because it had been so overhyped. There was an AI financial bubble in the 1980s. Go look it up on Wikipedia. It had been so overhyped. And then, of course, eventually it worked. So, look, I think there are things that don't have exponential forces behind them. Some things, for example, the physical world that people get excited about and try to apply these software computing paradigms onto them. So 3D printing maybe or something where people try to look at it like a computing movement, but in fact, it's just much more constrained. And there's only so many ways to build a bridge. You can't have a Moore's law of bridges. Physics does matter here. And it just turns out that the natural world allows you to pack with a lot of ingenuity, a lot more semiconductors on a chip in a way that other fields don't. So that does matter, but also these exponential forces matter. So in my career, I haven't seen anything that I would call a serious topic with serious software people working on it that didn't eventually work. I think it's almost always a question of timing. And I feel the same way about blockchains. And I do about, by the way, virtual reality, metaverse, all these things that are now in the trough of disillusionment. I just think it's a matter of time before they come back. And in fact, let's just take VR. I know it's not our main topic here, but there's easy things to predict and hard things to predict. The easy thing to predict with VR is those headsets are going to get smaller, better resolution, better performance, better software. That's inevitable. And the harder question is then in that world, how popular is it? What do people do with it? But certain things we just know. We know that these things are going to get a lot better and probably more popular as a result and cheaper and everything else. And so the more nuanced question then is figuring out the timing.
So there's this weird interaction, psychological outcome of an interaction between maybe peak of expectations and trough of disillusionment, because you get this very divisive, strong language and disagreement, the haters and the believers. And that's where things, we all know these quotes, rat poison and magic beans, it comes out. Chris, is that type of rancor and disagreement and frustration pretty typical of this stage of the cycle? And does it actually tell you where you could be in the cycle when you see this reaching a fever pitch?
There was some very strong negativity in the early 2000s around the internet. I do think that it's different now generally. I mean, you're starting to see this rancor against AI now from creative people who, there was a movie that used AI art in the poster and there was this big Twitter protest. So I think my reading is there's always been cynics and haters, but I guess two things. One is tech is just on a much bigger stage today. It's not, oh, those nerds in Silicon Valley. I think it's like 7 of the top 10 companies by market cap are tech. We used to be the pirates, now we're the Navy. It's just a different dynamic, number one. And number two, I think there's a political element that's now entered tech. In some sense I get that you'll see there's some partisanship. And I'm not particularly political and don't want to get deep into political topics, but just in the same way that you'd have, I don't know if you remember with COVID at the beginning, there was debates on masks. And at some point it became this tribal battle between two sides. I think a little bit of that is, especially in crypto, there's certain people, particularly, I would say, anti-business people on the left who have decided to make it an issue. So that's added another dimension. So I think there's always been some of it. It's a bigger stage now. And there's also just the general politicization of everything, tribalism that seems to have happened for whatever reasons. I'll leave that to smarter people to figure out why, but everything seems to be political these days in some sense.
Indeed. Yes, perhaps the soundbite of the hour is right there. It's interesting. You had this great quote from Clay Christensen in your book, who I know you're a fan of. And it's something like, incumbents often whiff at new technologies because the next big thing often looks like a toy. The one thing in common of all these cycles is that there's a lot of creative destruction, a lot of rationalization, a lot of failures as we all figure this out. Business models take shape and ultimately profitability use cases ultimately emerge. But what Clay's point is getting at is that often the staying power rests with those that are counterpositioning and innovators rather than the institutions. Can you talk a little bit about why that is?
Yeah, so I think his ideas are extremely important, and I cite them a lot. I think there's a few points he makes. The first one, my version of it, is the next big thing. It starts out looking like a toy. And he has a famous chart where the demands of the market is this line that's only going up a little bit. And then the quality of the products is going up much faster. And so when the quality is below, it's dismissed. So early PCs, I think at the time, the market was for computers were big mainframes for business. And those were the people that paid for computers. So you come out with a PC and this is just a crappy mainframe. Now, what the skeptics didn't see, among other things, was that those PCs would get much, much better. And that goes back to the exponential forces point. You have these very powerful exponential forces. Things that are toys can, in a very short amount of time, be much more than that. So in some ways, that idea is a reframing of the exponential forces idea. The second important thing that Christensen talks about, I think, is that often these so-called disruptive technologies are misaligned business-wise with the incumbent business model. So I think an interesting example is people often look at something like Sears, the retailer, as a example of a company that was killed by the internet or sort of killed by the internet. They actually owned, I think it was Prodigy. So there were three big internet providers in the 1980s, believe it or not. It was CompuServe, Prodigy, and AOL. I mean, big. They had millions of customers, not billions. But Sears, I think it was in the 80s, they bought, I believe it was Prodigy. So they saw the internet coming. It would be like someone buying OpenAI a couple of years ago. It was like the hot thing and you saw it coming and you bought it. So you would think, okay, these guys were on top of it. So why did they get crushed so badly? By the way, I think if you go back and look at the history of the internet, a lot of like Barnes & Noble had very early with barnesandnoble.com, a whole bunch of cases like this where incumbents saw it coming. The problem was for Sears to truly respond to Amazon, they would have had to shut down their stores because they had a cost structure that just didn't fit with the internet. So what happened in reality is all these companies did see it coming, but really, really struggled to reshape their business model in light of this new technology, where the optimal strategy was just, in the case of Amazon, until recently at least, was to have no stores and to just have robotic fulfillment centers and all those other kinds of things that Amazon did. So to me, the kind of two key ideas with Christensen is one, look for exponential forces, look for things that seem like toys. If there's an exponential force, there are toys that remain toys. Okay. So the difference between toys that remain toys and toys that don't are these forces that drive it. And the second thing is, especially if you're in my job and you're doing startup investing, look for things where the business models of the startups are misaligned with the incumbent business models. Because when they're aligned, it's a very interesting question today with AI. You have blockchains. I would argue AI, incredibly powerful, incredibly important technology. All the excitement that people talk about, I think, is justified. That said, when you look at it through the lens of an entrepreneur or an investor, I would argue it's a sustaining technology. It's not disruptive in the sense that it's fully aligned with the business models of the incumbents. Adobe Ads has a new button in Photoshop that's generative fill. Google Cloud and Amazon Web Services will have a new cloud service that's, LLMs and other things like that. Take your existing enterprise business software and add a new module, add new features. If you're Facebook, you can now use Instagram to generate better images, better filters. So it's different than the internet, and the internet came along and just these existing cost structures didn't make sense. Now, maybe I'm wrong. Maybe there will be new technology is nuanced and things change, and maybe there'll be new disruptive things that pop out of it. But at the moment, it looks more sustaining, which doesn't mean there's not a million opportunities. It's just they're different types of opportunities, and you have to be nuanced. Whereas blockchains and tokens are definitely truly disruptive in the sense that it's a radically different way to build networks. This is a thesis of my book, to build internet services. And those internet services have a very different economic model than the internet services of the incumbents. And if these blockchain networks continue to grow, it will be very, very hard for the incumbents to respond to it without making really dramatic measures because it is truly disruptive.
Let's use that as a segue to shift to this next era that you describe in the book. I will say, though, just before we leave these institutional powerhouses that maybe are reluctant to shift, I still miss, Chris, those just sublime social explosions that were Friday night at the Blockbuster. I do think we lost something when we went to Netflix, but...
Yeah. I'm a big reader and I still love independent bookstores. I don't know how long that business model will survive. I think there's definitely all of these technology movements have pros and cons.
So let's use your mental maps of this hype cycle and some of the intersecting forces as our backdrop for your new book, and particularly the way that you have articulated blockchain networking's role in the future. You structure your book, which is really interesting. It's the title of the book, but you structure it around this trajectory of read, write, and own, which is largely a reflection of Web 1.0, 2.0, and 3.0. So can you walk us through how that has evolved?
So really, this is a book about networks. And let me just explain that is that I took this for granted. So I go out and talk to lots of people about these topics. And in talking to them, I realized they'd ask me what blockchains, like, what do they use them for? I'm like, well, it's a new way to build networks. And they would say, well, why would you want to build networks? And then I said, oh, wow, I need to do some more explaining here. Because to give you background, if you're in my business, so I've spent my entire career on the internet, meaning I was an internet entrepreneur and then internet investor. And if that's your job, and a lot of my friends, that's been their job, we're basically in the network business because the thing you do with the internet is you build networks. So the way to think of it is the internet itself is a network of computers, internet protocol networks, these physical devices. And then on top of that is our other networks. The World Wide Web is a network. Email is a network. Facebook is a network. Twitter is a network. Uber is a network. If you're an entrepreneur in the 2000s, as I was, you're trying to build a network. If you're an investor like me, you're trying to invest in networks. Basically, almost all of the apps you look at on your phone, they are networks. They have, very importantly, what are called network effects. Network effects means they get more useful the more people use them. In Warren Buffett terminology, that's a moat, a network effect. And I would argue it's the most powerful moat in the world. It's far more powerful than the classic Michael Porter 5 forces. And we can go into a whole bunch of reasons why. So this is important background. And part of why I wrote the book is I realized in having these conversations about blockchains that people didn't have that prerequisite knowledge if they weren't internet people. And I finally came to the conclusion, I just can't explain this topic in an hour. I need a book. So that's the motivation. And I go through all of this, I hope, in pretty clear, straightforward language in this book. This is interesting to people, but they don't fully understand what I'm saying. I think I explained it on the book. Okay, so the internet's a network of networks. The thing you do if you're an entrepreneur and investor on the internet is you try to build or invest in networks. And basically, there are 3 ways to build networks. The first way are what I call protocol networks. Sometimes they're called protocols. And that was how the early internet was built. And the most prominent protocol networks are email and the World Wide Web. And protocol networks have a bunch of features, but the most salient ones here would be that, one, they're community controlled. There's no company or person who controls the World Wide Web. It's effectively controlled by this large community of users, software developers, and others who use that system. And as a result, for example, that means that there are what we call in the internet business take rates. There are no take rates. Take rate is the percentage of money flowing through a network taken by the network operator. So, for example, on your iPhone, if you make a payment in an app, Apple takes 30%. Facebook takes 100%. They run ads. They make $100 billion in revenue. They don't share any of that revenue with creators. The protocol networks, there is no one in the middle. They don't take any rent. They don't charge anything. There's no one to charge. That's very important. And I think that led to a lot of the success of the 90s internet. Because if you were Larry Page or Jeff Bezos or somebody building a website, you knew if you built that website that you really owned it, that if somebody paid you money or whatever, you would get that money. So in the same way that property rights in the offline world, if you provide an incentive to build things, the protocol networks provided a very strong incentive to build around it, to build websites, to build email newsletter services or whatever it might be. And then in the 2000s, and that I call the read era, the 90s era. Read era, because this is not my terminology, the read era. The idea is a common term in the internet world. Read era, because most of the 90s internet was about consuming information, reading information. In the 2000s, you had the crash, and then you had this rebuilding period. I was part of that. I was an entrepreneur. People called that the read-write era. They also called it the Web 2 era. It was called read-write because the idea was that the entrepreneurs in that era were motivated by the idea that the internet could be more than a passive way to consume media. It could be a two-way medium. It could not only democratize the consumption of information, but the publishing of information. So that was the rise of blogging, Facebook, Twitter, YouTube. It was social media as we know it today. So that was the read-write era. It was a great thing. Billions of people now have access to free internet services. I'm very pro-internet, but there was a downside, which is the dominant networks of that era were architected differently than the dominant networks of the 90s. Instead of protocol networks, we got what I call corporate networks. So if you look at a network like Twitter or Facebook, they're very different than email and the web in that there is a company sitting in the middle that has complete control. And they control the economics, and they use that control to their advantage. They control who has access. They control the algorithms. They control all sorts of things. They control what developers can access those systems. So my core belief is that in the 2000s, it was just good news, bad news. The good news is we got very powerful systems. The internet became much more powerful. Many more people have access. We had the rise of broadband and mobile, of course, which accelerated all of that. The bad news is we handed over control to a small set of companies that have network effects. Network effects are naturally consolidated, meaning that the more people that use a service, the more valuable it gets. And we have a situation today where you essentially have 5 companies that control 95% plus of all of the money and traffic on the internet. And I believe all the trends show that will get even more consolidated, and AI will accelerate that consolidation. So that's the core issue. The internet is at serious risk of becoming radio and TV in the 60s and 70s or something, where you have 3 channels. So when blockchains came along and started to grow in functionality, I was interested in them because blockchains are a new way to create networks. Bitcoin is a network. Ethereum is a network. Bitcoin's not a ledger. When you hear people say it's a ledger, that's just a very unhelpful way to think about it. It's a network. It's a network that lets you move Bitcoins around. You may or may not think that's a useful network, but that's what it is. It's a network. And Bitcoin pioneered this idea that you could have this new kind of network, which I believe, and this is why I got involved in the space, blockchain networks combine the best features, I believe, of the 2 prior kinds of networks. They combine the advanced functionality of corporate networks with the societal benefits of protocol networks. So the book is structured. The beginning of it is an explanation of these phenomenon, and then a history going through protocol networks, corporate networks, explains what blockchains are, and then explains the benefits of blockchains. But the core idea is thesis, antithesis, synthesis. It's protocol networks gave us the rise of this amazing thing. Then you had this counterforce of these corporate networks, and blockchain networks are the best of both worlds. And the reason I call it read, write, own is that one of the most salient features of blockchain networks is they enable digital ownership. Just give you an example. You can build a social network. People have built, and there are some growing social networks built on blockchains that function the way that something like Twitter functions in terms of you download an app and you use it, feels like that and has the same kind of experience. The big difference is the user owns his or her identity and his or her followers. So what that means is if you don't like what the provider is doing, they're changing the algorithm or changing the economics, you can switch in the same way you can switch browsers or you can switch email clients. Protocol networks let you switch as well. If you use Substack to send emails to your newsletter readers and they do something you don't like, you can switch to whatever, MailChimp or something. Why can you switch? Because protocol networks let you own those email addresses. There's not some company that controls it the way that Twitter or Facebook controls it. So blockchain networks, the core feature is ownership. Users own the things they care about. And because users own the things they care about, that lets them switch, and it reduces the power of the network operators and the software providers, and ultimately changes the economics of these systems. Very important. By the way, I go through this in detail. So I have a section on take rates. I have a section on network governance, a section on all these things, and really walk through how it works today, how these new systems work, and so forth.
So, Chris, you talked about, these are my words, not yours, but the holy grail of a moat being this network economy, network economics, scale that increases the value with each marginal user. You also talked with that great example of the iPhone, this pouring octane into the tank as far as the app software loop to get to that network economics. Is there an equivalent? And you touched on it. Maybe it's take rate, maybe it's ownership of content, maybe it's a little bit of both. What is the corollary or self-reinforcing loop for a blockchain network to get to those network economies?
So blockchains also have a network effect. It's in the networks, as do protocol networks. The difference is that blockchain networks, like protocol networks, there's a network effect, but it doesn't accrue to a company. There's not a company that controls that. It accrues to a community. So email has a network effect, meaning the more people that use email, the more valuable it gets. But there isn't a company that controls that. It's the community of all email users benefit as that community grows. And blockchains are similar in that way. In terms of the forces, there's a few of them. One is blockchains, they're computers, they're technologies. And so there's infrastructure. And that infrastructure has gotten significantly better over the years. So specifically, just a brief history of blockchain. So you had Bitcoin in 2008, which is this very specific application. It's this Bitcoin service, digital gold. The big next thing that happened in 2015 was Ethereum. And Ethereum took that idea and generalized it and said, it's a blockchain, but it also has an app store, quote unquote. Yeah, anyone can write software for the Ethereum blockchain. You can just sit down, write some code, upload it to the blockchain, and it runs that code. And that made it a generalized computer. Now, the problem with Ethereum in 2015 is to run a piece of code might cost you $10. You have to pay for it. It's like a shared mainframe computer of the old days. So that just was very prohibitive and meant the only applications people ran were things where sometimes they would cost $100. So what applications can you run at $100? It turned out to be people trading and speculating. Today, there are systems on Ethereum, for example, what are called layer 2s, L2s, where pretty regularly you have sub-penny transaction costs. So that has followed blockchain price performance, has followed its own Moore's law. So that's one important exponential force. The second is it's a network, and so it's a social product. The more people that use Ethereum, the more application developers that build for it, the more useful it gets. So that's very important. So the Ethereum community is probably about, if you look at wallets like MetaMask, 30 million users. And these are people that are really using it for games and social networks and other things, NFT collecting. And, that's a lot of people. It's tiny by today's internet scale, less than 1% of the users. But as that grows, as more applications are built, et cetera, it could ride a similar exponential force as other.
So one of the things we haven't talked yet about that I want to shift to is a key mechanism that blockchain networks introduce, which is this idea of a token. And we've alluded to cryptocurrency, which is just one form of a token, as you're very clear to talk about. I think this gets back to the rancor and the divisiveness, Chris. And part of the reason I really wanted to have you on is that I find you refreshingly vocal as not a blind, euphoric force, but somebody that actually can separate the wheat and the chaff. The computer versus the casino is the language that you use. So this is way more than unicorns on an NFT and garbage coins. Help us understand the effective role, the important role of a token.
As you mentioned, look, there's plenty of people who abuse this technology. And I think in a well-functioning regulatory environment, those people would be stopped. Unfortunately, that's not happening right now. I think probably, even though there's been regulatory crackdowns, I think it's basically been on the good actors and the bad actors. There's probably more scams and other kinds of bad behavior than ever because of, I think, very misguided regulatory enforcement. So yes, I think there are financial aspects to this technology, and that definitely attracts bad actors, and there are definitely misuses of it. So I'm not by any means saying everything is good here. Let me explain, though, there are productive uses for tokens, and done right, they're very powerful. So I think Ethereum is a good example. The way to think of Ethereum is this computer running in the sky that runs on top of a network of other computers. And I go through this in the book, and I probably won't go through it in detail now because it's a little bit complicated, but think of it as a virtual computer. If you're a software developer, you can upload things to Ethereum and you can think of it as a single computer. But in fact, it's a computer that runs, there's 30,000 what are called validators that every second or so come together and vote on the state of the computer. So physically, it's running on this network, but it acts as a single computer. Those validators that run the network have to pay for bandwidth and electricity. So they need a business model, right? You need a way to pay for the hosting of this computer. So how do you have a business model for someone running an internet service? One way is you have a company behind it. And that's what Google and Facebook do. But the problem with that is the problems with Google and Facebook. They use the fact that it's running on their computer to start extracting the money and the control. As someone said, the cloud is just another way of saying someone else's computer. Every time you're on the cloud, you're on someone else's computer. And what these companies have learned to do is to exploit the fact that you're on their computer. They take your data, they take your money. With Ethereum, you're saying, okay, well, what's another way to pay for hosting that's not giving all the control away to these companies? And that's where the token comes in. So the way Ethereum works is if you want to run some software on the system, you have to pay what's called gas. And gas is a small fee for using computational resources on the system. And you pay with that through the token. And then in turn, that money that you pay is then distributed out to those validators, to those hosting providers. So it's a business model for an internet service that doesn't require having a big company behind it. That's one of the core ideas here. How do you have a community of people own a network that has expenses, that has OpEx, without handing control over to a company? So this is one of the very clever ideas that was originally pioneered in Bitcoin and furthered in Ethereum. So that's where the token comes in. You need a way to pay for stuff. And by the way, Ethereum has cash flow. One of the frustrating myths about this whole space is that these are magic beans. They're unproductive assets. It would take 10 minutes of research to figure out that Ethereum has cash flow. There's a P, you can value it on a PE ratio. In the last 12 months, last time I checked, which was maybe a month ago, Ethereum generated about $2 billion worth of fees. People paid $2 billion in aggregate to access the network. And that money is in turn, some of that spent in the validators to pay for hosting costs. And some of it is burnt, which means it uses it to destroy Ether and lower the supply of the tokens. It's a little sort of microeconomy, pretty straightforward to go do traditional financial analysis of it. And the token has that purpose. Now, the problem comes as you have FTX and other kinds of bad actors who take those tokens, put them on a website, hype them up. People don't understand what they're for, and then create thousands of copies and other versions that don't actually have a purpose and hype them up. And then consumers come along and some of them fall for these things. And if you're a scammer, you're attracted to this. It takes work to go and understand how Ethereum works and distinguish it from a scam or something like this. So what we've been saying for a very long time, for many years, long before FTX and all these other things, is that we need regulation around this that allows for the productive side, but eliminates the scams. And I hope that eventually that will happen. It hasn't happened so far. Generally, and this is whether it's AI or blockchains, I think one of my core arguments would be that the right way to think about tech policy is to go really understand the technology, understand what positive societal benefits are, understand what the drawbacks are, and then craft a policy that maximizes the good and minimizes the bad. A big part of why I wrote this book is I felt like the positive side of blockchains had not been explained. So I would argue that that's what we should be thinking about, as opposed to having these political food fights and yelling at each other and all the other things that's going on, which unfortunately just don't think the level of discussion around this has been particularly productive. If you look at critiques of my book, I don't think I've seen a single actual critique of someone who read it and critiqued the arguments. It's all ad hominem. It's just a very emotionally, politically charged environment where there's not, I think, a lot of real engagement on the topics.
It is indeed. Yeah. And hopefully at Capital Decanted, at least, we're attempting to strike that balance of intellectual honesty, but also being objective as you're exhorting us to be. Chris, you talked a little bit about the $2 billion of cash flow. These are real business models in a lot of cases. But also, you're in the business of venture capital. You're in the business of seeding early stage businesses. So by definition, there's a little bit of betting on a founder, betting on an idea, betting on a business model. As a VC investor, how do you think about valuing some of these enterprises so you don't get caught up in, again, going back to the old days, extrapolating clicks into an enterprise value from Web 1.0?
I do mostly early stage investing. In early stage investing, I'd love to tell you that whether it's crypto or not, I'd love to tell you it's rational and there's spreadsheets involved. But having done startup investing for a long time, inside and outside, a lot of it's just supply and demand. And you'll have three people an idea and they'll get a $50 million valuation. And that's pretty common in Silicon Valley. And on the one hand, it sounds crazy. On the other hand, there's a lot of data that shows that if you're good at it, that can work as an investment model. So a lot of it's early stage. It's more based on the team and the idea, and the valuations are pretty unscientific. My assumption with all of this stuff is eventually everything will end up being PE ratios. And I think this is the core assumption of all venture capital, is that in the very long term, everything will be something that trades on something like a value to earnings ratio. I think as you get later, we have a growth fund at the firm, and they are very focused on operating margins, and they do real deep cash flow analysis and things like that. As you go earlier, you get a little bit less quantitative is how it works. And I have a couple chapters in the book on this. The thing I described with Ethereum, our assumption is in the end, if these blockchain networks work, they'll have a real use. They'll power the next generation of social networks and games and financial services and payments and all these other kinds of things. And there'll be real money flowing through. The network will take some portion of that money, and that will somehow then accrue back to the token holders. And ultimately, in the long term, there'll be people valuing those on some traditional financial measures of price to earnings and growth rate and all the other kinds of things. But that could be 20 years away. So you're working backwards and you're saying, who are the people who are visionary enough to think about this? Step one is build great products. Step two is make those products popular. And step three is capture value from that popularity.
So let's bring that to life a little bit for perhaps the layman or consumer that is listening. You spend one of the final chapters, I think, bringing to life some use cases, applications. Chris, you can choose DeFi or gaming or networks or tokens, whatever you want, but maybe give us a couple real life examples.
So just to give some context in the book. So the first section is history of the internet. And the second section is an explanation of blockchains and why they matter. And then the third, people have criticized me and others for being abstract. So in the third section, I take 7 topics and try to go really concrete as to what people are building with blockchains and why they have a positive benefit. One I mentioned before is social networks, where the key thing with social networks to understand today is there are the top 5 social networks generated $150 billion in revenue last year. And basically all of that money went to the social networks. Whereas, why do you go to Instagram and TikTok? Do you go to see content created by Instagram and TikTok? No, you go to see content created by other people. But these networks have figured out a way to get people to do all of the work for them, but yet not give them any of the money. I go through it in the book. Some of them have these creator reward programs, but it's sub 1% of the revenue. So it's really immaterial. So one very powerful and important new application with blockchains, and people are building these things, are social networks where the economics are truly peer-to-peer. So the people doing the work get paid for doing the work. So that's one. I think there's a bunch of interesting stuff involving AI. So take deep fakes as an example, which is going to be a growing problem, which is, do you know if this video is real? Do you know if this person is real? Is this a bot talking to me? The right way to solve that problem is with cryptography and blockchains. The right way to solve that is we need a system on the internet for saying this is a real person. This is a real piece of content. This is the New York Times, and the New York Times attests this content is real. This cryptographic code represents Joe Biden, and this piece of content was signed by him as being authentic. What's the mechanism for doing that, and where do you store that signature? That's a very interesting use case for a blockchain. And if you don't do it with a blockchain, you're going to have Facebook and Google do it, and you're going to just give them even more power. Someone needs to provide that function, and I would argue the best way to do that would be a blockchain and not another service provided by Facebook and Google. There's a bunch of, I think, interesting ideas. One of my favorite ideas I'll just mention is called collaborative storytelling. And the idea is, if you think of systems like Wikipedia, where you have a crowd of people coming together, creating a crowdsourced encyclopedia, what some of these new blockchain-based startups are working on is this idea that you could have a crowd of people come together and create a narrative universe. So the next Marvel or the next Harry Potter could be created by a fan community who develops the idea, develops the characters, develops the storylines, and then in proportion to their contribution to that idea, get rewarded with tokens. So get rewarded with the economic benefits. And so if that narrative world gets licensed to make a movie, or probably in a couple of years, you'll just be able to make a movie with generative AI, and you'll make comics and you'll make games. The people that contributed creatively get paid for that. I think that's especially interesting in a world we may be entering soon, where a lot of the existing business models for creative people may go away because of AI. So in that world, we need new ways to make sure those people get paid. And I think that's a really powerful one. I have a chapter on that. Search is about to go away, that search business model. So the model today, if you're a news website or you're a cooking website or just you run a website. So the way it works today is you allow Google to crawl your website and to index you and to show snippets of your website in the search results. You do that with the assumption that they'll send you some amount of traffic back. That's the covenant of the internet today. And they send you traffic back, and then you as a website either have ads or subscriptions. That's the relationship we have today between search engines and the rest of the internet. That's about to change because I don't know if you've used ChatGPT or Claude or Meta AI or whatever. You say, hey, what's a recipe for this? And it just shows you the recipe. You don't need to click through anymore. So what's going to happen to all these people who depend on those clicks? So I have another chapter on this, which is, I think what you need is new business models for content providers. At the same time, by the way, those content providers are like, how are these AI systems able to give that answer? Because they crawled those content providers. And those people are not getting paid for that. I think, for example, a really interesting idea is you get these content providers together and they together set terms and say, you can use our data and you can give answers, but if you make some amount of money off of it, we need to get a portion of that.
Crowdsource key lime pie.
Yeah, and the way to do that is with blockchains. Blockchains are collective bargaining machines. It's a way to get a group of small players together and mediate the economic relationships with bigger players.
Maybe I'll ask you to close with, I mentioned it earlier, partially in jest, but the NFT world is probably the most misunderstood part of the whole token environment. But there is powerful technology underlying the caricatures that we often hear about this. But what would be a use case for NFTs?
So an NFT is just a token that's not fungible. It's not interchangeable. So when I mentioned these social networks where your identity is portable and you control it, that's an NFT. So I have C. Dixon on Twitter. If you go to Twitter/C. Dixon, that's my handle on Twitter, but I don't own that handle. And Elon Musk could take it away tomorrow, even though I've built over 15 years. Whereas my website I own, cdixon.org, I own that. In the case of blockchain-based social networks, as an example, via an NFT, you own your identity, you own your followers. There are a bunch of people making video games where if you collect magic swords and outfits and things, those are NFTs. You own them. You can take them, keep them, move them from one game to another. In the collaborative storytelling idea I was describing to you, the characters and the stories, these are all, I own a piece of this character I invented through an NFT. So NFT is just a mechanism of ownership. It gets made fun of in things because people conflate it. They conflate the technology of NFT with specific instantiations of the technology. Some of the avatar stuff and the PFP stuff, Bored Apes and things. Some people don't like that. And then they think that's what NFTs are. It could be like in the 90s, confusing certain websites you don't like with the general concept of a website. The original vision of the web was let's have a sea of information connected by hyperlinks, but that would quickly get overwhelming. And so there was this very clever idea, which is let's segment it, encapsulate it into these websites. The vision of blockchains is let's have an internet where people can own things. NFTs are just a way to encapsulate and simplify that concept of ownership. But that's ultimately what it is. The other thing, by the way, there's a whole movement now around, for example, real world assets where you take An obvious one is stablecoins. Stablecoins are tokens that represent dollars, for example. They're actually backed by a dollar in a bank somewhere, and you can redeem them. And people are doing that with other things around NFTs, where you can have a legal contract or a piece of IP or some other kinds of things. So it's just a very general concept, like a website. And the NFT standard was finalized in 2020. I mean, that's the other thing to keep in mind, this 4-year-old technology. So I think people are getting ahead of themselves, thinking that we fully explored this very generalized concept.
Last question, Chris, just as we leave. As a VC investor, again, we hear about the things you say yes to, but you say no to a whole lot too. In the read, write, own era, I know we can clearly see you're excited about a lot, but what keeps you up at night? What worries you about this new phase of build?
The main thing, I think this is true not just in blockchain, but in AI, is there's just a very, very heavy pushback on the regulatory side. So that's where we spend a lot of our time. On AI, there's a serious attempt to effectively ban open source AI. And we think it's really regulatory capture of big companies. And I think some of the things happening in blockchains. And that's just different than tech 20 years ago, where it was just under the radar and ignored. There were obviously regulations around the internet, but they were very positive. It wasn't nearly as contentious. So honestly, that's the main thing. I think otherwise, there's a lot of smart people working on this stuff. There's a lot of momentum. I think otherwise, there's the usual lots of blocking and tackling kind of things. But to me, that's really the only existential risk, is just that we get the wrong policies and we end up with a gray area industry that's not fulfilling its potential.
Well, for the listeners, just yesterday, we're recording this on May 17th. Just yesterday, a couple of colleagues of Chris wrote an op-ed in the Wall Street Journal on just that subject. So I'd commend that to you. And of course, the book we've been talking at length about, Read, Write, Own by Chris Dixon. Chris, I am so grateful, as are the listeners, for your time with us. We're going to have to leave it there. And listeners, stay tuned for the last sip.
Great. Thank you, John.
Welcome back to Capital Decanted and the last sip. Well, Christy, you've listened to the conversation with Chris Dixon. I really feel like we learned and sat at his feet on the history of platform computing. It was so interesting. That really should be a class, honestly, in undergrad for those that want to pursue investing, because I think it's become more and more of a foundational part of how to think about the world, not just technology, but how to think about the world. But I'm most interested, Christy, in determining whether you learned anything new as far as use cases, particularly your granny test. Is anything in there that Chris talked about change your view so we can get away from the Bitcoin endless debates to something much more interesting, which is blockchain use cases? So would love to hear from you.
So a couple of things after listening through that. I completely agree with you on his thoughtfulness and insight as an investor. I found it really interesting and insightful. And in particular, a couple of points that I completely agreed with him on and began to say in our earlier part that we recorded before, but the idea that context matters and that understanding, I believe he called them exponential forces, but to me, I just call it context, and how anytime that you're not just looking for something that fits a specific thing or that has a lot of buzz, you do really have to look at things that have that specific tailwind. And I also appreciated that about a third of the way into the interview, I think it was 25 minutes in, he mentioned that he talked to a lot of people. And it was this throwaway line, but I think that it is actually one of the most insightful things you can do in terms of understanding the broader context and those exponential forces. Because it's just like any market, it's too much for any one human to have their pulse on every single factoid. One of my favorite comments was there's been a lot of ideas that have been pinging around in my mind about what's truly disruptive versus what's a sustaining technology. And I think he brought it up in terms of AI, which I really appreciated. And he mentioned that AI, it seems like it's being pushed as more of a disruptive technology. And in fact, it's sustaining. So I think he actually, from pointing that out, made me less cynical in some ways, because I think the cynicalness, if you will, comes from the idea that AI and some of these newer technologies are going to just help sustain business models of these top 5 giants or however the big 10 in tech indefinitely. But actually, he brought in a lot of history and context and reminded me that there have been a lot of periods of consolidation, whether it be in radio and TV, now in tech, that does over time get eroded by disruptive technologies, potentially like Web3, like blockchain. This idea of people owning their own content again versus it being consolidated within a corporate network. So I came away from that being much more, I don't know, I don't have rose-colored glasses about the future, but it feels much less dystopian to me, if you will. And putting it in the context of the granny test is, yeah, my granny may not understand it, but at the same time, I think that absolutely business models will come and go, whether old people get it or not, myself included. And it's interesting. It was interesting to have that context. So what were your thoughts?
Yeah, I think Granny would love the next Marvel Cinematic Universe created through blockchain. That would be really cool. I love those ideas. I think you're right. I think if you read his book, I mean, there's no doubt that while Chris and A16Z were early investors in some of these big corporate networks, he's very concerned morally and socially about the monopolistic nature. And very much the premise of the book is going back and taking what was advantageous in the old protocol networks, combining them, what has been so socially helpful on the corporate networks, and creating the best of both worlds network model and architecture. So I had a couple reflections or observations that were a bit of paradoxes or tension the more I thought about it. And I don't think we talked about it with Chris or even in our intro. But one of them is about AI as well, Christy, to your point, which is one of the things that Chris has talked about is that blockchain could finally create kind of a golden age for creators. As you just alluded to, as we talked at length about, it allows for creators to be compensated properly or to participate properly versus the current corporate networks where all the take rates go to the owner of the network. So creative folks, intellectual property is better protected. These assets are ones that belong to the owner of the creative endeavor. And yet AI is potentially a technology that could be working against that. My son and daughter-in-law, as you know, are in advertising, and a lot of their digital artwork and digital creations and fine art, they are extremely concerned about some of the AI tools that just steal and mop up and slightly adapt and really leave the creators in the dust. And so there's this weird irony is that in one sense, one force, AI, even if it is sustaining, is working against creators, and yet blockchain network technologies could actually create a golden age. And how those two kind of play out, I'm sure I'm being particularly extreme in the way I'm posing these two forces against each other, but there are elements that are at odds. And I think how that plays out will just be interesting to watch. The other one is one that as a dad, I think about a lot. And you mentioned it, it was early in our discussion in the intro, which is sometimes technological innovation isn't always good for society. I think sometimes we need to think about that. The ecosystem, I think, sometimes fails to pause and just say, okay, yes, this might save some money, but is it good for humans? Is it good for civilization? And we've all seen the research, watched the documentaries. Again, I think about this with our children with phones all the time. A lot of this Web3 world and what the implications that's had on depression, suicide rates, social capabilities. Is this all good? And how do we at least govern what will be the ability to live your life inside of a virtual world and rely less and less on human interaction? And I'm not saying that blockchain networks are the epitome of that, but they are one part of this larger recipe that is creating ease and convenience and excuses and opportunity to live ultimately by yourself and just as a digital avatar instead of a real person. So I would just caution us to always be thinking about that. Again, I'm not pointing fingers at any technology in particular, but we sometimes let this ball start rolling and don't really stop to think, should it really continue to go at this pace and inevitably speed up? So those were my two cautions, not to bring downers, but I think that episode was a whole lot of fun. I learned a ton, and those were just the couple yellow flags I'd throw in along the way.
John advises everyone out there to go touch some grass. It's actually great advice.
Exactly. Indeed. Go to the beach, unplug the phone. It is healthy. All right. Fun question. We're excited about this one. Christy, if you were on the proverbial island, or speaking of your dystopian comment, if the apocalypse was upon us, what would be your last meal, your go-to food?
So this one's actually tough for me because as many of our friends and listeners out there know, I am 8 months pregnant. And so what my body craves is so weird right now. And if I went off of today, it would be Crispix at 2 a.m. and a random hodgepodge of things, peanut butter and jelly sandwiches on toasted bread. But I think that if I were to be more realistic, I have a horrible sweet tooth. And I know any meal, I'm a Texan, so probably steak, potatoes, and then Bluebell cookie two-step, which is an ice cream mashup of amazingness that Bluebell created. And it's chocolate chip cookie dough and cookies and cream ice cream all mixed into one. And it sounds weird, but it's so good. So yeah, I definitely, no matter what, there would be some cookie two-step. So thanks, Bluebell, for creating that. What's yours, John?
That is so Texas.
It is. It's such a Texas last meal.
So I'm going to do a 3-course meal. My 3-course meal delivered on that island would be, I would start with a charcuterie plate. I'm a huge cheese and crackers and fine meats fan. That is my go-to. That is often our Friday evening sunset on the deck meal. So start with a charcuterie. In the strangest of ways, my main course would be a big bowl of guacamole. Love me some guacamole.
Wait, with chips or just spooning it?
No, not spooning it. That's a good point. I should clarify. Yes, with good chips. My wife's guacamole is unbelievable. So that would be the main course. And then I would finish with another one of my wife's specialties, which I've often said is the best tasting thing I've ever had in my mouth, which is her strawberry rhubarb pie. Unbelievable. So there's my sweet tooth finish, the strong finish. So charcuterie board, big vat of guac, and finish it off, palate cleanser, strawberry rhubarb. And then the comet can hit.
I was going to say after that, yeah, I feel like that would be a perfectly rounded out meal. You got protein, you got vegetables, and you got the dessert. So that sounds amazing.
Bucket list complete at that point.
Bucket list complete. Check. I mean, hopefully we don't have to worry about the end of the world anytime soon, but.
So overall, I think we're pretty cheap dates. I think that's become clear.
I don't know. Those charcuterie boards can get expensive.
Now, that is true. Inflation has hit charcuterie hard. All right. Well, that was a very long episode. I appreciate if you're still listening that you hung with us. I hope you learned as much as we did. There was just so much to tackle as we think about what could be really a transformative next computing paradigm. So I hope you enjoyed it. We certainly did. And we will see you next time on Capital Decanted.